All right, welcome to part two of the Accounting 651 video lecture for this week. And again, we're talking about corporations and operating rules. And when we left off, we had walked through the timing, the amount, and the limitations associated with corporate charitable contributions. So, one of the things that we discussed is that the limit is 10% of a modified taxable income. So there are two ways to get at this particular limit in the world of academics. And since that's what you're facing, it probably makes sense to go over them. So the first one is get the components of taxable income and construct modified taxable income. So that would mean that you'd have revenues, operating expenses, charitable deductions, dividends received deduction. You'd have all those parts and you'd simply construct modified taxable income. But in real life, it simply doesn't work like that, right? The real life way is you start with taxable income and then you reverse engineer to get to modified taxable income. So let's start with Orange Corporation. And Orange Corporation has income from operations of $140,000, expenses of $110,000, dividends received of $10,000, charitable contributions of $6,000, and we need to piece together the modified taxable income, right? So this is under the first way. So we'd say, okay, well, 140,000 minus 110,000 plus the dividends received of 10,000, all that together equals 40,000 times 10%. That's a $4,000 limit. So we're not really adjusting. Notice that there's no dividends received deduction in here. And again, I know we haven't covered it yet because, of course, that's not to be included when we're calculating modified taxable income. And of course, same with the charitable contribution itself. Notice it is not part of our calculation of 40,000. The alternative way of looking at this would be to say Orange Corp has taxable income of 24,000, and that includes a charitable deduction of 6,000 and dividends received from a 100% sub of 10,000. So using this, we would piece together modified taxable income. We'd say, okay, well, I'm going to start with taxable income of 24,000. I'm going to add back the charitable deduction of 6,000. I'm going to add back the dividends received of 10,000, and that gets me to the same 40,000. So all I'm pointing out, think of it like bottom up, top down kind of approach. Same idea. All right, so there used to be this great thing called the domestic production activities deduction. It's gone. So we discussed it once already. You take your qualified production activities income, you multiply it by 9%, it has some limitations. We don't have to go there because it's over. So let's talk about net operating losses. So of course, this is different than a net capital loss. This is one where the operating results of a corporation are negative. And the purpose is to show that when a corporation has volatile earnings versus a corporation that has steady earnings, we are trying to create some sort of parity between those two types of entities. So we've got Jacob Corp with a very steady state of income. We've got Black Corp, who's very volatile, and let's assume a 30% tax rate. So Jacob has steady Eddie 10,000 of taxable income each year for a total of 30,000, which means at a 30% tax rate it pays 3,000, 3,000, 3,000 and 9,000. But if we look at Man in Black Corp, it's very volatile. So 20,000 in year 1, 15,000 loss in year 2, then a $25,000 income in year 3. But notice that we net to the same amount, a net 30,000. But because in a world where there is no net operating loss, we would pay taxes in a year with positive income, but we would not pay taxes in a year without, we actually end up paying more tax. And so this sort of volatility could create differing taxes, and that's not very equitable over any sort of long run. So this is why we have the net operating loss. And so first we're going to discuss briefly the net operating loss for 2017 and prior. And even though the rules have changed, they've changed in a way that a net operating loss generated in 2017 and prior continues to be treated under those rules. So there is no doubt in San Diego in particular with biotech companies that operate at losses, you may someday have a client that still has an NOL from 2017 and prior. So we really need to understand those rules, and then we'll talk about the new rules next. Okay, so if the NOL is 2017 and prior, it can be carried back or carried forward, very similar to the net capital loss. And again, a carryback is simply, think of it like refiling a prior tax return. It would have a new tax liability because I would have absorbed some of the income on that prior year return with some of this loss, and I'd request a refund. And carrying it forward means I'm going to use the net operating loss to reduce taxable income in a future year. So this is an NOL is available to both individuals and corporations, but we are only going to talk about the corporate form because, well, we're in corporate tax. So the 2017 rules were you could carry it back 2 years and then forward 20 years. And the general rule required you to start with a carryback to the extent you could. So that meant you had to go back to the first year. So you'd have to go back to 2 years ago. So for example, X Corp incurs a net operating loss in 2015. It has to start with 2013 and use any NOL in 2013, then 2014. And then if there's any NOL left, it carries it forward, of course, to 2016 and beyond. You simply cannot start with 2014. Now, you can if you had an NOL in 2013, but again, think about net capital losses. We have to do these on a FIFO basis. So I'd have to use up my 2013 NOL before I could even worry about a 2015 one. So a corporation can elect to skip carryback and use only carry forward. So a classic example of this would be a biotech corp that's a startup venture. And let's assume it made just a little bit or hardly any money in its first years. But it thinks someday when its drug gets approved, it's going to, print money. It's going to print taxable income. And so it may elect to skip the carryback and say, look, what I want to do is use this in a carry forward fashion because I can offset a greater amount of income. This was particularly more important in a world with progressive corporate tax rates. Of course, now that we're in a world of 21% tax rates, that means carrying it forward may not make any sense. It can play into things like what is the amount of charitable deduction? So maybe, once you got your FDA approval, you'd say, oh, look, I want to make a big charitable deduction. Well, if you use that carry forward NOL, remember that's not an adjustment to modified taxable income, it was only carried backs, then that would lower your taxable income in that year and you'd be able to make less. The other thing is, of course, time value of money, right? It's almost always better to get your refund today than wait to get it in the future. Okay, so net operating losses in 28 and beyond, the new rules are that NOLs can only be carried forward, but they can be carried forward indefinitely, meaning they simply don't expire. However, there is an 80% rule, and that 80% rule says you may not use an NOL to offset more than 80% of the current year's income. So let's do an example. Horcrux Corp incurs an NOL of $50,000 in 2018. So it can only carry it forward. So even if it had taxable income in prior years, that doesn't do it any good. So Horcrux generates taxable income of $40,000 in 2019. It may only use $32,000 of its NOL in 2019. That's the income for 2019, $40,000 times 80%. The remaining $18,000, so that's the $50,000 NOL minus the $32,000 we use in 2019, gets carried forward. Now, if Horcrux generates taxable income of $20,000 in 2020, 20,000 times 80% is 16,000. They can use 16,000 of their NOL, but of course that leaves a remaining 2,000 to continue to be carried forward. So NOLs created prior to 2018 again, retain the characteristics of the old NOL system. So what that would mean is a 2017 NOL, you can use 100% against future income, and it's the same to carryback to forward 20. So obviously, a carryback would have already been invoked at this point. So we would simply be dealing with a 20% carry forward. And yeah, if I generate an NOL in 2017, I really only have 20 years to use it. It's not indefinite. So Riddle Corp has an NOL of 20,000 in the 2017 tax year. And Riddle reported the following taxable income from 14 through 16. So in 14, 10,000, in 15, 17,000, and in 16, 8,000. So what options do they have with respect to this current year NOL in 2017? Well, they could carry 17,000 back to 2015, then have 3,000 left for 2016, and that would provide an immediate refund. Or it could forego the carryback and carryback and only carry the loss forward for 20 years. So you cannot carry back only to 2016. Now, I'm not sure why I wrote 2016 there. What I really meant is, oh, sorry, no, I did mean that. You cannot carry back to only 2016. You have to go back to 2015 because that was 2 years ago. And note that 2014 is not even part of this equation because that was 3 years ago. So the election to carry forward only applies only to that one annual NOL. So you can actually make different elections for each annual net operating loss should you generate one. Okay, so there is an interaction between net capital losses and net operating losses. So let's recall that net capital losses are not deductible by corporations, right? So first you would offset any capital gains, and then you would be left with a net capital loss. You could carry it back 3 years and then carry it forward 5 years. And we use those carryover amounts on a FIFO basis. However, you may not carry back a net capital loss if it creates or increases a net operating loss. So let's assume XYZ has a net capital loss of 4,000 for the 2017 tax year. And XYZ reported the following in 2015 and 16. So in 15, XYZ had a $17,000 net operating loss. But included inside that, because remember, there's no difference for corporations. I mean, they're treated as capital versus not capital, but they're all taxed at the same rate. So included inside that $17,000 loss is $2,000 of net capital gains. And in 2016, there's 8,000 of taxable income, and that includes 13,000 of net capital gains. And so the question is, what options does XYZ have with respect to the current year net capital loss? Recalling we have a net capital loss of 4,000. So in 2015, if I'm looking at what my situation was, my original operating income must have been a loss of 19,000, and then I had cap gains of 2,000 and taxable income, therefore, of a loss of 17,000. So what would happen if I carried back that net capital loss and offset the capital gains? Well, my taxable income would go from 17,000 to 19,000. Well, obviously that increases the NOL, and as a result, I cannot carry it back to 2015. So the next phase is now look at 2016. So again, if I have 8,000 of taxable income and 13,000 of capital gains, if I look at the original situation, I must have had operating losses of 5,000. Offset with a 13,000 of cap gains leaves me with a taxable income of 8,000. If I carry that back, do I create or increase the NOL? And you can see that what happens is if I carry it back, then my capital gains are reduced to only 9,000. And I actually end up not with a taxable loss, but taxable income in 2016 of 4,000. So as a result, I have not created or increased an NOL for that year, and I'm absolutely permitted to carry that net capital loss back to 2016. Okay, so the next topic we need to talk about is the dividends received deduction. So let's say the parent corporation owns 100% of the child corporation, and child corporation generates $1 million in taxable income. So, since each corporation is its own taxable entity, Child Corp pays 21% tax, that's 210,000, and then distributes the after-tax cash of 790 to parent. And let's assume parent generates only $1 of taxable income and receives 790,000 of dividend income from the child. So that would imply that the total taxable income is 790,001, and the parent has to pay tax of 21% on that, or another 165,900, and then distributes the net amount 624,101 to the owners. And let's assume the owners of the parent are the individuals, and they pay the 15% tax on the amount they received. That's another 93,615. So when we think about it, inside the parent-child system, it generated $1,001 of taxable income. It pays taxes of 210 at the child level, another 165 at the parent level, another 93,615 at the individual level, or taxes of 469,515. That's a 47% tax rate. And Congress realized that, well, that means creating parent-child corporations becomes very untenable. So they created something called the dividends received deduction. And that is exactly what it sounds like. You get to take a deduction against any of the dividend income you receive. This is only true for corporations. Of course, individuals do not get a dividends received deduction. Okay. So the idea is this mitigates more than two levels of tax, right? So corporations, yes, they're going to be subject to two levels of tax, but not three, four, five, six, depending on how big the parent-child, grandchild, great-grandchild chain is. So the DRD percentage, the amount you get to deduct, is a percent of the actual dividend you receive. And that percentage amount varies by the percentage of ownership you have in that subsidiary corporation. So, for example, if parent owns 0 to 19.99% of the child, then the dividends received deduction percentage is currently in 2018 50%. And you can see that the DRD percentages used to be larger in prior years, and that's really only presented for comparative purposes. So if they, for example, own 35% of the child, well, 35 is in the 20 to 79.99%, and they would take a 65% dividends received deduction. And of course, if they own 80% or more, they take a 100% dividends received deduction, which means that that dividend coming up from the child isn't even taxable to the parent at all. So there is a limitation on the DRD, of course, there always is. So the first limitation is, of course, the dividend amount times the DRD percent, right? I don't even view that as a limit. Think of that as the actual DRD. The limit is actually the DRD modified taxable income. So, okay, we've got a new taxable income times the DRD percentage. And the DRD modified taxable income in this case is, of course, taxable income before the DRD and before any NOL and capital loss carrybacks. However, there's an exception to that limit. In this case, if the full DRD, or think of it as the actual DRD, would extend or create an NOL, now the limit simply doesn't apply. Okay, there's probably only one way to do this, and that's use an example. So let's assume that in all of these instances, what we're dealing with is an investment in a subsidiary that is less than 20%. So just so we understand, we're down in the 50% DRD category. Okay, so we're looking at Hagrid Corp. And Hagrid Corp has gross income from operations of 400,000, expenses from operations of 340, and it has received dividends of 200,000. So taxable income before any dividends received deduction is the 400 minus the 340 plus the 200, or 260. So step one is compute the full DRD. Well, since it received 200,000 in dividends, we multiply that by 50%. That gives us an actual DRD, or a full DRD, of 100,000. Now we calculate the taxable income limit. In this instance, it's the 260,000 of taxable income before the DRD times 50% or 130,000. Since the actual or full DRD is less than the limit, then Hagrid can take the full DRD of 100,000. And it simply does not cause an NOL, right? Because taxable income is taxable income less the full DRD does not cause an NOL. Okay, now let's do McGonigal Corp. So McGonigal Corp has gross income from operations of 320,000, expenses of 340, and that same dividend received of 200,000. In this case, taxable income before the DRD is 180,000. The full DRD is 200,000 times 50% or 100,000. In this case, the taxable income limit is 180,000 times 50%, which is only 90,000. Since a full DRD of 100,000 would not create a loss, right? 180 minus 100,000 is still 80,000 of income. As a result, that doesn't cause an NOL. It is limited, and so the DRD is only 90,000. All right, to care to venture a guess what's going to happen in version 3. Flitwick Corp has gross income from ops of 210, the same expenses and the same dividends received. So now, because revenue is so low, the taxable income before any DRD is down to 70,000. The full DRD is the same, 200,000 times 50% or 100,000. But now, since taxable income is only 70,000, when I calculate the limit, it's only 35,000. And normally we'd say, oh, well, it must be subject to the limit. However, if you use the full DRD against taxable income before the DRD, you get an NOL of 30,000. Because that does cause an NOL, you are permitted to take the full DRD of 100,000. So how do you become eligible for the DRD? So not every corporation is eligible. So an investor corporation purchases 1,000 shares of publicly held common stock for 15,000 on June 3rd. The ex-dividend date for that investment is on June 5th. So if you don't know what the ex-dividend date is, that's the date at which the shareholders of record are credited with a dividend. Now, it may not be paid to them, but if you own that stock on June 5th, then you receive the dividend. So Investor Corp therefore receives its dividend of $1,000 on June 10th. Well, think about what happens to the price of stock on the ex-dividend date. So in theory, if that stock was worth $15 and it's going to pay $1 per share dividend, then now it's only worth $14 because it's lost $1 value. It's paying it out to its shareholders. What would happen is Investor Corporation would use a DRD to wipe away that income, but it would then sell that stock for $14,000 and generate a loss because, of course, that price is adjusted for the distribution of dividend. So that would create a dividend bailout, and the code simply doesn't allow that. So what it says is you're not eligible for a DRD unless you have held that stock for more than 45 days during the test period. And the test period starts 45 days before the ex-dividend date and lasts for 45 days after the ex-dividend date. So that's a total of 90 days plus the actual ex-div date, or a total of 91 days. So if we look at this instance, the Investor Corp only bought the stock on June 3rd. It sells it on June 15th. It's only held it for 12 days. Since the test period of, well, it doesn't even matter when the test period is, it certainly hasn't held it for 45 days. As a result, it would not be entitled to the DRD. If, on the other hand, it held that stock until December 1st, and December 1st is just a hypothetical, it will have held that stock all the way from June 3rd all the way till December 1st. That's clearly more than 45 days, and as a result, it would be entitled to the DRD. Okay, so there is some other corporate stuff, but I promised you guys I was going to keep my lectures to an hour. We're basically at the hour, And so what will happen is this additional lecture will be deferred until next week. So, whether you like the videos or not, hopefully they at least taught you something. So I will see you in class. Thanks for listening.